Hello, everybody. Welcome to this, I guess you'd call it special one-off webinar about body corporate insurance. So I'm Chris Irons and I'm Strata Advisor, former Commissioner for Body Corporate Community Management, and I'm with Hines Legal. My guest speaker today, Chris Glass from Honan Insurance. Chris, welcome.
Hey Chris, how are you?
I'm good, and I'm very happy that we can see and hear each other loud and clear today after some issues in our previous attempt to do this, which is good because we've got a topic that everyone wants to hear about, frankly, about insurance. When you talk about insurance, it's not necessarily the most thrilling thing that comes to mind, and yet for every person, particularly every person in the body corporate, Chris, it's forefront and foremost in mind, isn't it? It's one of the most important things that they'll need to take care of.
Oh, look, there's no doubt in terms of recurring expenditure, it's probably, if not the largest, one of the top three largest expenses they would incur in the budget every year.
Absolutely. We're going to try and cover a bit of a general discussion today about insurance, and then delve into some of the specifics around insurance in Strata, particularly some of the issues that we see occurring in North Queensland in particular. And we're going to try and end things today with some practical tips, practical advice to try and make the situation better if possible. Chris, first of all, to you. So Honan Insurance Broker, and you're pretty much devoted to the Strata market, aren't you?
Our broking firm, yes, very much so. We're probably second, maybe third largest Strata broker in the country. We employ probably 55 to 60 staff nationally in our Strata division only. We're not just Strata brokers, but within the business, we're especially Strata brokers, very much so.
So you would see a lot of what goes on and a lot of how things pan out. What are you seeing out there in the market for insurance, and particularly for Strata insurance at the moment? What's coming across your desk?
I think the overwhelming thing that we are seeing, and it has been consistent for the last, honestly, 3 years now, is that the insurance market cycle, and if you can imagine, it was a clock face, and 6 o'clock down the bottom is the lowest premiums that we can achieve. And then at the top, we've got 12 o'clock, and that is the hardest market. We're probably getting very close to 12 o'clock now. So that we are seeing, there's no question that if we went back 3 or 4 years, maybe 4 years ago now, the market was down the bottom of that cycle when the premiums were the lowest, honestly, or the rate that they were charging was the lowest it has been in probably the last 10 years prior to that. Very quickly, the cycle has turned and we've gone up through 9 o'clock, 10 o'clock, 11 o'clock, and we're pretty well close to the top of the hard cycle right now. And that's meant that premiums have consistently increased for the last 3 to 4 years. Including far North Queensland, because their increases have been much more dramatic. But on an average, for a building of asset value of $10 million or less, they've probably seen a 40 to 50% increase in premium from 2016 to 2020, if they've had no claims.
And that's a lot, isn't it?
Yeah, it is. And that cycle is a product of lots of things. And where we are at the moment within the cycle, at being at the top and almost the hardest it can be, is there's some factors that drive that. One factor is the amount of competition that's in the marketplace. How many insurers are prepared to write Strata insurance? 6 years ago, we probably had 7 or 8. Now we're down to, including in fact, 6 years ago, we probably had 10, including the direct insurers that will deal direct with bodies corporate. Yep. And then you've got the insurers that deal direct with brokers and or body corporate managers. So you combine them, maybe 10 or 11 4 years ago. Now we're probably down to about 6, maybe 7. And that's the starting point. So less competition, but also within those insurers, they have very different appetites for risk than they had five years ago. Some now no longer want to write any business that's asset valued at more than $30 million. Some will only write business for asset values over $40 million. And there is some gaps in the market, and fewer are really happy to write business from, up to around about $6 to $7 to $8 million. There's fewer of those insurers in the marketplace, whereas 4 or 5 years ago, the marketplace was awash with those. So that is all of those factors, and there's more to it, have combined to actually reduce the capacity from the insurers and therefore their appetite from the insurers. Their cost for reinsurance has gone up, and they've gone up significantly, and that's a global trend as well. So those three factors, plus the losses that the insurers have suffered over the last 4 to 5 years, particularly around natural disasters, have significantly impacted the premiums, because they are not making an underwriting profit. So they can try and increase rates or put premiums up to try to get a return to underwriting profit. So it's a difficult market. It's still reasonably well supported. We will always find solutions, but the key will be is trying to make those solutions as affordable as possible. That's the big challenge, as we know, particularly for far north Queensland. Yeah,
no, that's right. I think that's a really good explanation, Chris, because it's not just insurers sitting around in a boardroom picking a figure out of the air and saying, you know what, we're just going to increase premiums by 40% this year because we can. It's much more nuanced than that, isn't it?
Oh, absolutely. Just to give you an idea of the insured losses, I read an article yesterday that the insured losses for the year 1920, or the last 12 months, let's say the last 12 months, is something like $4.85 billion, or $5.85 billion for Australia only.
Yeah.
Hailstorms, the terrible bushfires, clearly, the floods that occurred. Then we had another set of hailstorms. Even that little hailstorm we copped in Western Brisbane last week, 2 weekends ago. The insured losses for that alone are around about 160 to 180 million. That only hit one suburb.
Yep.
And those sorts of things are driving premium. There is no question about it, Chris.
Yep. Yeah, no, absolutely. I mean, just on that topic, and a bit of a random question, Chris, but I mean, how well do you think that bodies, corporate committees, body corporate managers understand how the insurance market and their kind of insurance obligations? Do you think there's a good understanding out there?
Oh, they understand their obligations under the Act, that the asset has to be insured for full replacement value. There's no question about that. I think, and particularly in the last 4 years, because the conversation's changed about, the premium goes down, people are happy, we think, great, we saved a bit of money this year. But now the conversation's changed, and brokers like us, Strata managers, are now having a different conversation. It's not about how much premium we've been able to drive down, but it's also about, well, look, the rates are going up, premiums are going up. What can we do collectively to actually minimise, for your particular risk, the potential for premium increases?
Yeah.
Bodies corporate with multiple claims for the same cause, and they're generally water, but not exclusively. We'll be finding now that the insurers are asking about not just what happens, they know that, but what's the body corporate doing to prevent it from happening again? And we're spending a lot more time at committee level, at body corporate manager level, asking those questions, showing quotes, showing proof of work done to the insurers to say, we've got this body corporate that's particularly serious about managing that part of the risk, and this is what they're doing. So that to me is it's clearly a different conversation that we were having 4 or 5 years ago, and therefore, and the committees are better educated as a result, I think, about not so much the way the market works, that's our job, but what their role in managing risk is.
Yeah. It's that eternal struggle, isn't it, Chris, between short-term and long-term thinking. The short-term thinking is that's going to cost us a lot of money to be proactive and preventative. At this point, we don't want to make that kind of decision, as opposed to the long-term thinking, which is if we do this now, then further down the track, we stand to be in a much better position than we are. And not only that, but it goes towards the value of the property. I mean, your end game here is always that you want to preserve and grow how much your property is worth. And if you're not doing these preventative things, that worth just drops off.
I mean, that's the cause and effect is clear. The interesting thing in around claims and claims trends is that there's no doubt that water damage is still a hot topic. That's where the most frequent claims come from, and the size of claims are growing. Now, to give you an example, we have a very large complex that has had 3 fairly major water damage claims over the last 7 or 8 years. The most recent one was probably 2 years ago. And that water damage claim was around about $550,000. The 2 prior to that, which were about 4 years before that, were probably on average a couple of $100,000 each. Now, different insurers, okay, but the current insurer, when we came to renew that, there was a penalty for in terms of premium, which the body corporate was prepared for and budgeted for, because we were working with them from day one. The insurer also tried to put a $50,000 water excess on this particular building. We got that down to $25,000, but $25,000 sitting in the balance sheet of the bank account of the body corporate for water damage claims is a significant impost.
It is, because somebody has to pay it, and that somebody is the owner every time. It frustrates me to no end, Chris, when people can't make that connection between that cost and the levy that they end up paying ultimately at the end of the day. Very frustrating. We talked a little bit, we alluded just before to North Queensland, which is where a lot of the focus of insurance issues are at the moment. So we might just delve into that a bit more. But first of all, Chris, what do we mean by North Queensland? Where is it, frankly?
That's where the palm trees are, isn't it? That's what I would say. I think traditionally and geographically, anything north of 26th parallel, which I think runs just north of Rocky from memory.
It does. Yeah.
It was, when we talk, that's the area. Anything above that would be deemed as North Queensland, and with that goes the cyclone risks. What has been happening now is that the insurers have been, for a number of years now, coming further down the coast. And to be honest, it may be on modelling they're doing, particularly in around, dare I say, climate change, or cyclone frequency and intensity is moving further south as well. I actually don't know that. I'm making a guess, but that is creeping down. And certainly the insurers as a group of Strata insurers, that is, as a group, there's a couple now that will not write basically anywhere above Bundaberg. Yeah. Whereas 4 or 5 years ago, pretty well everyone was sort of comfortable going up to about Rocky. And so it is creeping down. And I suspect the reason is that they're concerned for, the way the weather patterns are potentially changing and the risk goes. So, because don't forget, the further south you become, the less cyclone resilient a lot of properties will be, because they haven't been required to be. That's right. Yeah, it's a bit of a catch-22, isn't it? Yeah. So I mean, that's really good to know, because I'd had some feedback from a body corporate manager who said that they were trying to obtain cover for one of the buildings they manage, and it was in Bundaberg, and they were getting nowhere. And I was a bit surprised to hear that, but the way you've explained it, Chris, that's a really good explanation of that. So okay. North Queensland, then the issues, Chris, that I hear, there's 2 issues. Either there's no cover available whatsoever, or if there is cover available, it's at a rate that makes it a premium that is extraordinarily expensive for the body corporate. Is that your general view of things too? Yes. Unfortunately, I don't say that with any pleasure, believe me. The no cover one is an interesting one, that there is always a solution, but whether it's an affordable solution is really the key. Yeah. But what we do see is that excluding the bigger buildings. Now, a bigger building in far north Queensland is probably $20 million asset and above. And not to say they don't have much bigger ones, of course they do, but that's where the premium will be sitting.
Yep.
What we're seeing is that the direct insurers, and there's Suncorp, obviously is one. There's a new player called Insurance. They are broker driven, but also I think they do a little bit of direct as well. I believe Wesfarmers still are doing a little bit of work up there, and RACQ might be doing a little bit of work up there.
Some of that's with 3 stories or less, isn't it, Chris?
Yeah. They have very clear underwriting guidelines about the size of the building. For example, and please, I am making this up, but Suncorp maybe can't do anything beyond $3 million asset, and they can't do any more than, say, 10 lots in it. So what's actually happened is in far north, this time last year, we would comfortably say there was at least 3 broker-driven strata insurers, and that is Strata Unit Underwriters, SUU. We had Brooklyn Underwriting, which is an underwriting agency as well, and we have Longitude. They were the main 3.
Yep. And
then we had Suncorp and potentially, but sure wasn't around then, and potentially RACQ and Wesfarmers, and so it goes on. Now, what's actually happened is that in the last 12 months, and people in far north will be well aware of this, that Brooklyn, as of August this year, have ceased to renew and write any new business in Strata, full stop. And so we've gone from 3 players to 2. Last year, Longitude changed their security. So they're an underwriting agency and they use an underwriter or an insurer to actually carry the risk. And they changed their security from Vero to Chubb. Now, Chubb Insurance is a massive insurer. There's no problem with their security, but they have very little appetite for far north risks, and they have very little capacity, how much risk they can carry up there. Wasn't as broad as what Vero did. So Longitude are now writing fewer buildings in far north Queensland. SUU have remained pretty consistent there. They're tending to renew things, and for the right risks, they're offering, for the right new buildings, they are offering terms as well. But their capacity is probably shrunk a little bit. So that alone, again, indicates fewer competition, premium goes up. Now, what we are, as I said before, if the direct insurers can't help out, there's a gap between that $3 and $10 million limit that actually means that the premium would be, please I'm making this up, $5 million asset in Townsville that's got no claims. It was built in the last 6 to 7 years. It's got 12 lots in it. They probably should be paying, if they're in southeast Queensland, they'd be paying a $5 million asset, $4,000 to $5,000.
Yep. In
Townsville, they're probably paying, depending on how close to the coast they are, but they'll be paying $20,000.
Yeah. Maybe
more. Now, if the broker-driven market can't find a home for that at that sort of pricing, and the direct market, because it's too large, then it becomes harder. And we will be placing those risks not under a strata wording. We don't have to, and we're quite comfortable not placing them under strata, under a property policy or a business insurance policy, if we can get someone to do that as well. And those premiums are higher again.
Yeah. And
we're seeing in that instance, and they are prohibitively higher. And, and that becomes very much not a difficult conversation. That's I don't mean it for that, but it becomes very, very hard for the bodies corporate to go, look, I was paying $18,000 last year. Now you're telling me it's going to be $40,000 for a $5 million asset. Well, yes, because here's what we've done. We explain it very clearly, but there is literally nowhere else. So we can find solutions, but they're quite often unpalatable in terms of cost. And if they were claims affected, then they'll have massive excesses as well.
Yep.
And the premium will be even higher.
Yep.
Yeah, it's very difficult.
It's very tough, isn't it? And you know, we're seeing increasingly more and more of those kinds of concerns being expressed publicly and through the media. I think some of the affected bodies corporate up in that part of the world are not content to remain silent on the issue any longer, and so be interesting to see where that pans out. Chris, one of the things that gets raised from time to time is this mysterious sounding concept of parametric insurance.
Okay.
For our listeners out there who, I've got to tell you, love technical terms and knowing what they are. No, they do, seriously. What's parametric insurance?
Very good question. It's actually not a new product. It's been around for lots of years, but its application in far north Queensland, and in fact in far north WA, is becoming more. It's not widespread, but certainly there's more of it occurring. A parametric solution, and it doesn't have to be in around cyclone. It's generally in around an event or a weather peril. It could be flood, it could be hail, it could be whatever. In this instance, it's very much about cyclone. And what the parametric solution, in a current Strata policy, again, we've got a $20 million asset. The Strata policy will cover that $20 million asset for cyclone, for the full replacement value, $20 million. But you're paying a lot of that premium that you're paying, like most of it by a long way, is going towards the cyclone cover.
Yeah.
Because that's where the insurers perceive the risk to be. Now, what a parametric solution does, or a parametric option, is that the weather event that we're going to insure is cyclone and only cyclone. We have a separate policy for the property for fire and perils and storm and, you know, all
the rest of it. Yeah.
But we take out from the property policy the cyclone policy, and we place what we call a parametric solution or a parametric option. Now, what it is that it's based on an event occurring, a cyclone occurring, and tracking through a pre-agreed area, call it a radius because it's simple to explain.
Yep.
And let's just say we just choose Townsville and we put a pin in the middle of that and say, righto, we're going to buy parametric cover for a 50-kilometre radius around Townsville. And we have a cyclone come through, and we'll say it's a Cat 4. It comes through, just past, it just breaks the edge of that 50 kilometres and then moves further out. It just does a big loop and goes out again. In that scenario, the cyclone has breached the pre-agreed radius, and therefore the insurer will pay the agreed amount, even though there may be no damage to the body corporate at all. So it's not about, in a normal property policy, the trigger for the payment of the claim is property damage. There's got to be an insured event has damaged our property. In a parametric, it is not property damage. It is that the cyclone has entered the actual pre-agreed radius, and it can be any shape you want, but let's just call it circles, it's easier. Pre-agreed radius, and then that becomes the trigger. Now, even if there's no property damage, it pays, and the body corporate can use the funds that they would receive for the payment any way they want. Make the property more cyclone resilient. I don't know. Yeah. Now, the thing is though, you can buy, again, let's just use that $20 million building as an example. You could buy $20 million worth of cyclone cover through a parametric, but it'll be hugely expensive. So what we present as options are, and they can be an option for a 3 million, a 5 million aggregate. That's the most I pay in any one policy period. I think the biggest we present is probably around about an $8 million aggregate. So you don't buy full cover because, well, you can, but it becomes unaffordable.
Yep.
And then you choose what category cyclone are we going to insure for. So again, making the assumption that every building in far north Queensland is currently cyclone rated and therefore cyclone resilient, just make that assumption.
Yep.
That category 1, you're probably not going to insure. You can, but they'll charge you. Category 2, you're probably not. Category 3, you might be thinking about it. Category 4, 5, definitely. So, you know, you say, righto, and then how much cover am I going to buy for Category 3? Am I going to buy the full $6 million that we're choosing, or we'll take $3 million if it gets Cat 3? Cat 4, do we want 6 million, 3 million, or 4.5 million, whatever you want? And the premium's calculated using those parameters as well. To be perfectly honest though, Chris, the parametric solution generally becomes only affordable for the very large buildings.
Yeah.
That are paying, you know, hundreds of thousands of dollars worth of premium. You know, and again, the underwriting of it they obviously use Bureau Meteorology, cyclone mapping tools. There's a whole heap of stuff that they use to actually enable them to throw the dart at the dartboard.
Yeah, no, but I think that's really useful, Chris, and a good point to make about this is only going to be useful for a certain part of the market, but that's better than nothing, number one. Number two, it does bring into play, and I've talked about this before, we here at Hines get a number of inquiries about this now, about the concept of an alternative insurance, which is where a body corporate applies to the commissioner, not me, because that's not me anymore, but my successor, and applies to the commissioner for effectively a sanction from not having to get their full obligated insurance. And one of the parts of that obligated insurance is insuring to full replacement value. So there is an argument to suggest that potentially if you can't get full replacement value, and you touched a little bit upon there in an explanation, Chris, about circumstances in which full replacement value mightn't occur, there is still the opportunity to have those arrangements formalised through the regulatory body in Queensland, which is the Commissioner's Office. So that's a very, very superficial discussion about that issue, because there's a lot more involved in it than just that. I think for anybody watching this, I think what the message that's really emerging here, Chris, not just on this issue, but our discussion generally, is that no one thing exists in isolation. Typically, it's a number of things that you have to consider together to get the best outcome for your building.
Yeah, and I think on that note particularly, the important thing is for the body corporate, the broker, or whoever's managing the insurance program, begins work 3 months before it's due.
Yeah.
Because if there's bad news, you want to know it early so you can find alternatives. And if one of the alternatives, the body corporate has to make application to the commissioner for a variation in what you just described, you don't want to do that with a week before the policy is due to run out.
That is where a lot of bodies corporate come unstuck, in my experience. And so you're absolutely right, because that is highly unlikely to occur. But not only that, you need to think about the transparency component of things. If you are going to ask all of the owners to cough up an increased levy this year, you want to get that on the table sooner rather than later, because I say this to everybody in every situation: body corporate meetings and body corporate voting, it's a numbers game. If you don't have the numbers, it doesn't pass. So how do you get the numbers? You spend the time beforehand, shoring it up, making sure people are aware of what's going on beforehand. I know that some of the larger bodies corporate do things like town hall forums and information nights or information seminars, where they throw it open to everyone. Come along if you want. Tonight we're going to talk about this topic. And I think you've actually done a couple of those yourself, haven't you, Chris, when it comes to premiums?
Yeah, more than happy to do that. And again, the parametric, what my brief explanation is, it was just an introduction. We've got probably a 45-minute to an hour discussion, because that's what it generates in around a little bit more about what the parametric can look like. And we're doing more and more of those. So your point is well made. And I think the key takeaway from this section is just on that, if you think it's going to be a problem, start work really early on, 3 months before renewal date. So if there's nasty surprises, you can find options all the way through. And if one of the options is going to the Commissioner's Office, that should be there about a month before.
Yeah, as a minimum, Chris, definitely. Yeah. Look, I want to end things today on a practical and kind of constructive note, Chris. So we've talked a little bit about, well, not a little bit, a lot of what we've talked about has been a bit doom and gloom kind of stuff. But we've talked about this before, and there are actually things that bodies corporate can do to start the process of addressing the premium and hopefully even wearing it down. One of the key things, Chris, I think, is the valuation. So just for everybody's benefit, a body corporate is required to get a valuation. So that's in body corporate legislation. But Chris, there's valuation and there's valuation, isn't there?
And brokers will use the valuation reports as part of our submission. It's not the only part, clearly, but it's an important part of it. And we see a whole range of valuations, whether they're, I'll say detailed rather than high quality, but much more detailed, particularly around insurance style risk information,
yep,
rather than just the general fluff that we sometimes read. And that valuation should always be based upon a site visit by the valuer. And you would pay more for that, but we do know that you tend to pay for what you get in valuations. And when we're trying to, or we use that data, plus our own site visits when we're required to actually build the picture in the most accurate and the most glowing way about that particular body corporate. Yeah. Far North Queensland, you'd probably even ask the valuer if they can give some sort of commentary in and around cyclone resilience. And even, you know, and they may or may not be able to do that, but I'd be asking if they can, and do they do that in their valuations? Because again, the insurer's got a risk here and a risk there, and they're pretty well the same, but they're only able to write one of them. Which one are they going to choose? Well, they're going to choose the one that's presented in the best possible light.
And I think, Chris, that is a really good message for committees in particular. Committees who generally have the day-to-day decision-making powers about engaging or deciding to go ahead and do something. Committees have got to act reasonably, and part of acting reasonably is making an informed decision about how to do something. I think you've just hit the nail on the head with this one. I mean, if you know that there is an obligation to get a valuation and you're in the process of sourcing a quote and someone to do it, and you are faced with options which include site visit or no site visit, you've got to weigh it up really carefully, don't you?
Oh, you want the information to be as accurate as it possibly can, warts and all.
Yep.
But it's got to be as accurate as it possibly can, because the more information in these reports, particularly in and around cyclone resilience of Far North, and fire protection and age of building and all those sorts of things, are really, really, really important key underwriting information, which we go and get. But when it's backed up by a valuation, it has a more powerful impact on the presentation of the risk.
Absolutely. So I think that's a really key point for everyone. We've been getting a few questions lately about valuations, and I think that's a really good start point for people. Yeah. The second big thing, Chris, isn't it, is about the regular maintenance that a body corporate does or should be doing, isn't it? Because that, again, is something which can stand them in good stead when it comes to insurance.
Oh, very much so. And this applies for any body corporate, doesn't matter where it is. And we have great success in describing a risk, a building being a better risk to an insurer when we can provide to them maintenance program, maintenance budget, past and present and future. We've got a number of our buildings, small and large, that give me via their body corporate managers what they've done in the last 12 months, what they're going to do in the next 12 months, and what they're going to do in the next 3 years that are in the budget. And what that shows to the insurers is that we've got a committee that is serious about maintaining the asset, number one, but serious about minimising and managing the risks, number two. And it's not just about protecting your physical asset because it will go up in value. It's about protecting your physical asset so you don't have claims that will devalue, you know, your complex. We spent a lot of time talking to committees in and around that, And when we get that information, I believe it has powerful impact on the way the insurers will view particular risks.
Oh yeah, absolutely. I mean, it's interesting you say that. Just this week I was reading an adjudicator's order and it was about water damage, funnily enough. And in going through the motions of deciding it, the adjudicator came across some statement by the body corporate that they had a firm policy of denying liability regardless of the situation. So that was their blanket policy. We deny liability. And of course they lost in that particular case, and the adjudicator put them on notice and said, listen, you can't just go out there and say, we deny liability. You have to accept, you have to comply with your obligations. And if your obligation is to maintain common property to prevent water damage, that's what you do. And I think here we're seeing another consequence of that as well. If you don't maintain and you don't execute your responsibilities, there's not only the short-term problem, there's the far bigger problem later on about your insurance policy. Yeah. Chris, any kind of other final words of wisdom for people about body corporate insurance, North Queensland insurance that you can think of?
No, look, no. I think the summary though, the takeaway I'd like people to understand is that the market will turn. We're at 12 o'clock. We're going back to where we started at the beginning. It will eventually start to come back down. When that's going to be, I can't tell you. My gut feel is just looking at rates at the moment in southeast Queensland, they're starting to level out. They're not going up linearly. Yeah. They're still going up. Far North Queensland is probably going to continue to increase linearly for at least another 12 months. But the market will turn. It always does. So the pain everyone's going through now in terms of significantly increased premiums, eventually we'll get some relief. The other thing that I'd like you to take away is that, you know, particularly for committee members, think about your budgets on maintenance and doing critical things. Waterproofings are important, obviously. Replacing windows when we know that they're rusted out. Just to do the things that reduce water ingress and being able to demonstrate that is really, 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 really important. And internally, look at what's happening with flexi hoses on appliances, under sinks, in the bathroom. They have a very, very limited lifespan. And even the best of them, we're being told maybe 8 years at the most you'll get out of them. If they're a cheap import, you may be lucky to get 3 years. They are a major contributor to water damage. And even if the committee makes a decision to get the lot owners to replace all of those in the 12 months, that will give that insurer or the insurers greater confidence as well. Engage that. Once you're doing stuff, let the insurer know via your body corporate manager, via your broker or direct. It's very, very important.
Yeah, and it reinforces the point that I would make, Chris, which is transparency. Transparency is everything in this scenario. Transparency to the insurer, transparency to lot owners, transparency to people who are involved. It's always your best policy in this situation. And I think as we've demonstrated in this discussion, it's got the greatest chance of getting you a better result. And also looking at things early rather than late. Get in there as soon as you can, as soon as practical. Don't wait until a week before the renewal date to be doing something about it. That's probably going to be too late at that stage. Chris, great discussion today. Now, if people want to get in touch, I think they know how to get in touch with us, but getting in touch with you on sort of like a specific insurance query, what might be best there?
Oh, look, simply, if you just go to our website and you'll pick up our contacts there, and it's www.honan.com.au, and just ring the Brisbane office off that, much easier, or 3368 3708.
Excellent. And for us, it's hineslegal.com.au or info@hineslegal.com.au, 31930500. we've got that down pat, Chris. So look, I'm hoping that this discussion really sort of paints a big picture for people. It's not a simple topic. We could probably sit here and talk for hours about different other aspects of the topic, Chris, but I think this is the start point for people today, and particularly for our clients and friends up in North Queensland. It's tough, but if you can take a few sort of little gems of information out of what we've discussed today, and as Chris said, I think the really important point, it will turn around eventually. I think that's the important thing to bear in mind. Chris, thank you so much.
Thank you, my pleasure.
We'll talk to everyone later. Thanks all.
All the best. Thank you.